Welcome to the Techno Fundamental Report for November the 7th. Peter Lynch ran the Fidelity Magellan Fund for years. He's now retired. He used to talk a great deal about chasing 10 baggers. In other words, stocks that go up tenfold. His biggest winner back in the 70s and 80s was Walmart. He did quite well with Walmart. He used to go to Walmart stores and count the number of cars in the parking lot. So basically, to find a 10 bagger, you've got to actually buy high and sell higher. It's not buy low, sell high. It's all about attitude, and you don't want to be second guessing your strategy, but you've got to have the right attitude to be able to successfully do this. Now, the stock market, in my opinion, is a great deal. It's liquidity. You have liquidity. This is out of Battle for Investment Survival. It says a very important advantage of the liquid quoted security is the ability to follow the progress daily. Nothing is a quicker indicator of trouble than special and unusual weakness, and in many over-the-counter issues, or even the quiet listed ones, trouble will not be discovered until it's too late. So in other words, price is everything, and if you're getting abnormal prices, you've got a problem. But the main point here is that you only want to invest in liquid securities. You don't want to get involved in illiquid, which is small company, too small actually, many size. New book out, or a new book I discovered by Joe Terranova. It's called Buy High, Sell Higher: Why Buy and Hold is Dead and Other Surprising Investing Lessons. Nothing would make me happier than to have a buy and hold market. And there will be a time when that does happen. It happened back between 82 and 2000, and you have to have a bull market. But, the buy and hold strategy to me is incredibly risky because I've had so many experiences over the last decades where companies like, just give you an example, Eastman Kodak, they paid a dividend, they wouldn't cut the dividend, knew that there was a digital camera out there, and didn't take proper action. So basically, again, from the book, I took this quote. It says, "This method of selecting stocks is superior to trying to buy stocks on the cheap. When we buy low and sell high, we're really just buying stocks that appear to be bargains, but really are sucker bets because momentum and the majority of investors and trade is going against them." So you have to realize when a stock goes low, it's usually because they have a problem. Now, it can either be a turnaround situation or so forth, but up is good, down is bad. So you want to look for stocks that are going up. So to give you an example of what Terranova is talking about, and this was something we experienced, Apple, this is an example of Apple. In other words, it broke out when the market knew they had the phone. Now, this was 2003. And you can see it broke out and started trending upward. Whereas if it would have broken down, that wouldn't have been a good sign. So, give you an example of that. Here's Boeing. I had a good friend that, was telling me when Boeing was around $200 a share that he thought it was a good deal. Well, then it broke down. Okay, now it's cheap, we can buy it here, and then it breaks down again. Oh, well, it's cheap, and it just keeps going down. So the problem here is now you've got people who own the stock and bought the stock up here that are stuck. And every time the stock tries to rally, you've got an overhead of sellers. So you have what we call overhead supply. Jesse Livermore, he basically wrote about something called the elusive gypsy fish, and this was in his book. He says, "There's a time to go long, time to go short, and a time to go fishing." He loved to fish. He had a yacht off the coast of Palm Beach, and he would fish for gypsy fish, which were very rare and very hard to catch. And he basically said, when you're in your boat, you need to have 10 lines in the water, like 10 stocks in your portfolio, because you have to buy 10 to find one. That's how the statistics seem to work. You might find one, you might find two, but this is what Peter Lynch is talking about. You want to catch the big fish. You don't want to settle for it. Your attitude needs to be, I'm going for it. Now, let's go and review what's going on right now. We had a robust rally yesterday, and I want to remind you about the power trend. The power trend is still in effect because the power trend only ends when the 21-day crosses below the 50-day. Now, this indicator was developed by Mike Webster of Investors Business Daily. I'm still in somewhat of an experimental stage with it. Now, realize I have an inventory and a library of indicators that some have over the years have worked, some haven't worked, some work at different times. And it's just experience with these indicators that you finally figure out which ones to pay attention to. It's got to make sense. And so basically, let's refresh the rules here. The low has to be above the 21-day moving average for at least 10 days, which has been the case. The 21-day is above the 50-day, so the 21-day is above the 50-day. The 50-day is in an uptrend. It's in an uptrend. So basically, we're going to look at several indexes here that are all showing very positive power trend indications. Now, the idea behind the power trend is that you need to pretty much, not buy and hold, but you want to reduce trading. You want to loosen your stop losses a little bit. You don't want to be too tight on your stop losses. I've made that mistake before, and still make it to this day. It's very hard to do, and sometimes it's a stop loss. Sometimes it's a stop profit. And so what we've been having has been stop profits because we're taking profits on some things. So that's the NASDAQ. Okay, power trend here for the mid caps continues to stay in the power trend. Broke out very, very nicely on nice volume. So we got a good day yesterday. Here's the New York Stock Exchange, same thing. We started to see where the power trend was starting to get challenged, but it's back on track. So we're still in a power trend. Small caps, very big day, jumped 6% yesterday. This is a very positive sign. When you get the small caps moving, that's a true bull market, because the large caps, you want to have exposure to large caps, but realize most of the speculation gets squeezed out of these big companies because they're a $1 trillion company or a $3 trillion company. But a small company is somewhat riskier than a large company. So when you see this kind of action, it's telling you that risk is on. It's not off. S&P 500, you can see here as well, power trend still in place. Here's the equally weighted S&P 500. This is where we see a broadening out of the market, because these indexes, I think, are quite deceptive because they're market cap weighted. So in the past 2 years, these $1 trillion companies, they call them the Magnificent Seven, have been driving these indexes because they have the largest market capitalization. Therefore, they get all the attention. So when you go to an equally weighted index, it just kind of gives you a truer picture of what's going on. And then look at this volume. This was all buying volume that came in yesterday. So that's very positive. We got the unemployment report recently, and you can see basically unchanged. So, if interest rates can behave themselves, the economy is doing quite well. So let's look at interest rates here. You can see they've been edging up. In fact, yesterday, interest rates jumped 2.4%. And then the power index is also starting to a little bit troubling. We're getting up close to that zero mark. But the Fed started meeting on Wednesday, and they will report today. And the word is they're going to cut interest rates by 20.25. So here's another group that I thought was very interesting. This is a powerful situation here. This is the regional banks. If y'all remember the Silicon Valley Bank fiasco, these stocks were in serious trouble. Well, it looks like they're coming out of it. So if you keep the banking industry healthy, that certainly indicates a strong economy. So if you have any questions, please let me know. Thank you very much.